Elliott wave theory. This is the second lesson in the Advanced Forex Trading course. In this lesson, you will learn about the Elliott wave theory that is based on a 5-wave pattern. Towards the end of this lesson, you will also learn to build a trading strategy using the Elliott wave pattern. Introduction to Elliott wave theory. The prices in the financial markets continuously move up and down in repeated patterns that are called waves. Waves, Ralph Nelson Elliott was a stock trader who developed the Elliott wave theory back in the 1930s. The theory is very comprehensive and requires time and experience to master. According to Elliott, the trends in the financial markets occur due to investors' psychology. He found that the prices in the financial markets move in a recurring pattern. He called those patterns waves and started to analyze them and realized that those repeating waves or patterns can be used to predict the future price movement. According to Elliott wave theory, a trending market has 3 large impulsive waves and 2 correction waves, which form a 5-way pattern. Elliott labels these waves from 1 to 5. The pattern then follows a 3 waves correction, which are labeled as A, B, and C. Based on the theory, wave 2 is the first correction wave, and it should not be more than 60% of the first impulsive wave. Wave 4 is the second corrective wave, and it should not be more than 40% of the third impulsive wave. Elliott wave principle. Ralph Nelson Elliott is still considered by many the only worthy successor to Charles Dow in analyzing market movements. In fact, he not only confirmed Dow's studies, but also introduced a series of more precise definitions for each market phase. In particular, he added a series of forecasting elements that not only identify market trends, but also calculate achievable price levels. In a similar way to Dow's theory, Elliott's wave theory distinguishes price movements in terms of waves. Since the movement of the market prices is the product of human activity and therefore subject to natural rules, it tends to express recurring sequences of bullish and bearish waves, which can be traced back to a general model. The Elliott wave principle is based on the assumption that each market represents a phenomenon fueled by economic flows, induced by psychological currents, and governed by natural laws. If these were missing, it would not be possible to achieve any balance, and the prices would lead to convulsive, disorganized fluctuations. The market must be considered a phenomenon created and fed by men, and therefore permeated by irrational attitudes that characterize people's daily lives. Elliott wave theory relates these wave patterns to the mass psychology of investors. Their mood swings and confidence in the market create these price movement patterns, alternating between optimism and pessimism. The market does not record political, economic, and social events, but rather human reactions to these events. 3 rules to follow. There are 3 important rules in the Elliott wave theory that you need to follow to correctly identify a 5-wave pattern. Wave 3 cannot be the shortest wave in the 5-wave pattern, and its high should be higher than the first impulsive wave. Wave 2, corrective wave, should not drop below wave 1. If it retraces below wave 1, the 5-wave pattern will not be formed. Wave 4 cannot go below the high of wave 1. meaning its low has to be above the high of wave 1. Let's understand more about the impulsive and corrective waves now. Impulse waves. The Elliott wave principle states that the market moves in a 5 to 3 wave pattern. Whether bullish or bearish, the repetitive patterns described by this theory all comprise 8 waves. The first waves are called impulse waves, which move in the direction of the main trend, and the last 3 waves are corrective waves, which move against the trend. In this example, waves 1, 3, and 5 go with the prevailing trend, whereas waves 2 and 4 dips back in the opposite direction. Although waves 2 and 4 are not going in the direction of the trend, they must not be confused with the corrective waves A, B, and C. Impulse waves have large price moves, whereas the corrective waves tend to be smaller. There will, however, always be one impulse wave that is longer than the other 2, usually the third wave, as the masses drive up the price. Wave 1 is the initial price moving upwards as a small group of people buy when the price is low. Wave 2 slightly reverses and the price goes down slightly as investors book profits. Wave 3 involves the mass public deciding to trade, driving the price even higher. Wave 4 incurs more profit booking due to the expensive price of the instrument. Wave 5 is a small group of traders buying or selling the rising asset. Corrective waves. The 3 corrective waves, labeled A, B, and C, follow after the first 5 impulse waves, and when looked at in combination, go in the opposite direction to the impulse waves. This will either be downwards or upwards, depending on whether it's a bull or bear market. These 3 corrective waves can be grouped as part of 3 types of chart formations, although they tend to be less easily identifiable than impulse waves. Zigzag. If the corrective waves are in a zigzag formation, wave B tends to be the shortest compared with A and C. This depicts steep moves in price, going against the initial trend, and can occur numerous times. Flat. The flat formation is simpler, as typically the waves are all the same length. A sideways pattern will occur, correcting the impulse waves. Elliott wave fractals. Each wave, both impulsive and corrective, can be considered an independent repetitive pattern, which, when analyzed, can be further broken down into a series of 8 smaller subwaves or fractals. The ability to observe the same pattern at different time periods is what makes the theory fractal, and why it can also be said to mimic nature. In this theory, depending on the time period during which a wave is observed, the wave is referred to as grand supercycle wave. It lasts over a century. Upper cycle wave. It lasts a few decades. Cycle wave. It lasts a few years. Primary wave. It lasts about a year. Intermediate wave. It lasts a few months. Minor wave. It lasts a few weeks. Minute wave. It lasts a few days. Minute wave. It lasts a few hours. Subminute wave. It lasts a few minutes. Elliott wave strategy. Elliott wave theory is not associated with one single trading strategy. Different traders have different interpretations of the theory and have derived several strategies. However, one of the simplest strategies that can be adopted using Elliott wave theory is to ride the trend and take entries on correction waves. For example, if you have identified an uptrend and spotted the first 2 waves, you will take a buy entry on the second wave. The rule is that the second wave will retrace nearly 60% of the first wave, so that's where you will pull the trigger. After that, the third wave will start, and it is the longest wave in the pattern. Now, if you are a short-term trader, you can close your position as soon as the third wave shows the sign of retracement. For long-term traders who want to benefit from the entire trend, can hold their position until the 5th wave. Let's have a look at the USD JPY chart on which the first wave is indicating an upwards traction. After some bullish momentum, the first wave ends with a correction. This leads to the formation of a second wave, which is also our entry wave. Now the third wave is the longest wave, and for the short-term traders, the exit point is when the wave shows some signs of a correction. The long-term traders can continue holding their position until the 5th wave. However, the disadvantage for the long-term traders is that they will have one more corrective wave ahead. The same strategy can be applied for downtrending markets by opening sell entries after the second wave shows a 60% correction of the first wave. The exit for the short-term traders will be at the end of the third wave, while for the long-term traders, the exit will be when the 5th wave starts to retrace. It's worth noting that trading at wave 2 also poses a risk because at this point the trend is not fully established. So, to counter this problem, you can take a position on the 4th wave. Remember, the 4th wave is a correction wave, and the idea to enter on a correction wave is to get a better price. Also, remember that the 4th wave is likely to have a 40% correction of the 3rd wave. So, the ideal way to take a position is when the 4th wave has retraced 40%. This USD CAD chart is a classical example of a complete 5-wave pattern. The first downwards wave started from 1.3550 and ended when the second wave started from 1.3250. Based on our strategy, our entry point is where the second wave ends, and that is near 1.3430. The third wave eventually takes the price lower than the first wave. Now, this is the exit point for short-term traders, while the long-term trade can hold their position until the end of the 5th wave.